Hey guys, welcome back to another video, and in this video I want to break down the 34 rules keeping you poor in crypto. These are the rules that I've identified. Many of them I made myself, and some of them are an ongoing battle. But if we can identify the trappings, the failings that hold us back from success in crypto, then at least we have a chance of actually trying to rectify them and move forward. So let's start off straight into these 34 without further ado. If you appreciate this type of content, smash up the likes and don't forget to subscribe. Now the first one I want to cover off is FOMO. You've heard it before, but this is such a major trapping, and even the best informed minds still fall for this one, right? Everybody starts talking about a token, your taxi driver's talking about it, every crypto influencer is talking about it, and you get that little feeling in your heart, am I missing out? Am I missing out on this meme coin? This what's going on? You know, I need to jump in on Pepe or Shiba or Doge or Board coin, and then before you know it, you walked headfirst into a scam. And so this is why FOMO is one of the first things that will definitely keep yourself poor in crypto. Point number 2, keeping you poor in crypto is leverage. Yes, leverage. The number of new crypto trader or investors actively trading and investing with huge amounts of leverage is phenomenally insane, guys. This is crazy. And this is one of the biggest things I identify with new traders is they are aping in 10x, 20x, up to 100x, some of the even more than that positions. You have no need to be trading in leverage, particularly as a new trader investor. The crypto market is the most volatile asset class known to man. You don't need to increase that volatility. And this is the reason you keep getting liquidated and you keep getting back to $0 in your account. So leverage is a big no-go for me and definitely something I would not recommend a new investor or trader playing with. In a similar vein, rule number 3 is going to be margin. Margin is something else you should not be playing around with. If you want to stay poor in crypto, go and take out some margin, guys. Take out a loan, take out some margin, and start trading in some bunch of meme coins with a bunch of FOMO as well. And you'll see how quickly you're going to get wrecked. So another key component I see holding many investors back is a trade in margin and leverage, of course. Step number 4, analysis paralysis. Yes, this is when you just seek knowledge. I need to learn more. I need to learn more. I need to do more research. But then you do nothing. You're stuck. You have so much knowledge, but you've just increased the complexity and now you get stuck. You know so much that you're now too scared to invest in any project. All projects look risky to you because there's no perfect project. And as an investor or trader, you've got to be willing to take a risk. So don't get caught up in analysis paralysis. Rule number 5, if you want to continue to be a broke boy in crypto, you've got to continue to listen to those moon boys. Yes, those very same moon boys who will come on, show you a certain car, a certain lifestyle and tell you they've done that trading this altcoin, which is 1,000x, 2,000x altcoin. You've got to learn to do your research yourself and be careful who are you listening to. If you're listening to dumb people, you're going to get dumb results. Rule number 6, holding you back and keeping you poor in crypto is the lack of accountability. And this is a major one I continue to see anytime I'm speaking to someone who's not getting the results they want in crypto. It's often because they have a lack of accountability. They've always got some excuse. They've always got something or someone to blame. If a token drops, it's a big bag they're holding. It must be an influencer's fault. It must be the foundation of that project's fault. It must be an exchange's fault. It must be Sam Bankman-Fried's fault or the American government's fault or the economy's fault. Everybody's fault but your own. And that's the kind of mindset that's going to hold you back. You've got to learn to take accountability in life, and definitely in crypto, nobody else is to blame but yourself. Rule number 7, keeping you broke in crypto is the lack of eating of veg. Yes, I don't mean your Brussels sprouts or your broccoli. I mean making sure that you're adding the boring projects to your portfolio. You get excited by this crypto gem, this meme coin, this micro cap altcoin which could 1,000x, which is great. But you don't buy Bitcoin and Ethereum. You don't buy larger cap projects because you think they've tapped out their potential. They're already too big and boring for you, right? And this is a mindset that is holding you back. You've got to have a diversified portfolio and you've got to be eating your veg. Rule number 8 is getting fudded out. Yes, you had conviction in a project. You did all your research. You invested money in it. You love this project. And suddenly a news piece or a targeted campaign comes out on this project. Everybody in the Discord and in Telegram and Twitter are talking negatively about this project. And suddenly, for no technical or fundamental reason, you've now U-turned on this project. You've been fudded out by the community. And now you panic sell. You exit your position. This is going to keep holding you back, guys. You've got to have your conviction, and your conviction has to carry you through. Not news headlines, not FUD articles. If a tweet post can get you to change your mind on your crypto, You don't have conviction. Rule number 9, keeping you poor in crypto, is you don't listen to your intuition. Your intuition is born to detect scams, lies, deceits, something that just doesn't look right in a project, and too many people out there are kind of pushing that to the side. They're doing their research, they're listening to other people, but they're not listening to their gut. Does it feel right when you look at the founding team, when you listen to interviews, when you're doing your research? When that intuition comes in, it comes in for a reason, and definitely take onus on that and listen to your intuition instead of the opinions of other influencers who may have other incentives for telling you things. The 10th trait I notice in people who are destined to stay poor in crypto is they have no circle of competence. I meet them one day and they're this NFT day trader, and then I meet them a month later and now suddenly they're doing long-term proof of work layer 1 investments. What is your area of competence? Where is it in this great world of Web3 and crypto that you have an unfair advantage of? Right? You have a competitive advantage in that niche where you spend most of your time studying, have good knowledge of the projects in there, or are you just going to hope and spray? Right? You know a little bit about everything, but you're a master of nothing. Rule 11 is you're too easily swayed by others. Yes, you're that person that's like a feather in the wind. One day you like this project, you have so much conviction in it, but suddenly a friend taps you on the shoulder and says, I'm not too sure about that project, and suddenly you've done a full U-turn on it. You never had any good conviction in the first place. You place too much weight on what other people say, and you're looking for validation from other people liking your project instead of your own research. If you do this, if you find yourself doing this, this is a major thing that will keep you poor in crypto. Rule number 12 I see causing a lot of problems in the crypto space is a lack of patience. A lack of patience. Everybody wants that 1000x overnight. Nobody likes a bear market. Everybody's impatient in a bear market, where if we all just had a little bit more patience, just think how different your portfolio would be. The reality is anybody who's invested in Bitcoin or any of the major cryptos over the last 10 or so years has done well. The problem is people are buying in at the tops, being impatient, getting flooded out, and selling for low prices, and then blaming the crypto market for their lack of profits. You're not able to protect your funds. The first step of investing or trading is you've got to protect the funds which you brought into the market in the first place. If you keep leaking funds through scams, through phishing attacks, through other shady projects, you're going to constantly hold yourself back. So your first thing you need to be doing and figuring out is how to protect your funds. Rule number 14, keeping people poor in crypto, is the constant usage of unreliable exchanges. For some reason, there are certain people that think it's okay to be using a tiny little exchange with very little volume, very little history, very little trust, just because they're saving a little bit on fees. This is a huge fallacy, guys. Remember the previous point. You've got to protect your assets, and that means using big, reliable exchanges and diversifying across exchanges too. Rule number 15, you have no exit strategy. You have no guide on how to profit take. In fact, you've not even thought about profit taking. You've just bought a bunch of cryptos, and you're waiting for this thing called a bull market, and you think suddenly you're going to have the discipline to smartly execute how to profit take. Huge failing, huge trapping. If you are learning how to take profits now in the midst of a bear market, you're making a major mistake. And I'll leave a link in the description to a video where I share my personal profit taking strategy. Rule number 16 that I find holding crypto investors back is a lack of principles and red flags. Yes, what are your red flags? What do you stand for? What are your ethics? What are your morals? What are your red lines by which you say, if you cross these red lines, project, I'm no longer having conviction in this project. I cannot hold this project. I see so many people so emotionally attached to their project that the project founders and team could do absolutely anything, and yet still they're going to swear by this project because they love it, right? And they hide behind the fact that they're just hodling, when in reality, they just have a lack of principle. Rule number 17, which I spot in most people lacking results in crypto, is overconfidence and ego. That bravado, that arrogance to think you know it all, you can pick any project and it's going to do well, that is holding you back in crypto. You've got to have a little bit of humility. You've got to understand that even the best investors in the world can fail, and you're no different. Just because you had one that got you lucky doesn't mean you can repeat the process. And if you want to build sustainable wealth, You've got to be able to do it time and time again. Rule number 18, keeping you broke in crypto, is you're too busy flexing before investing. Yes, you want to buy the Rolex, you want to buy the car, you want to live that life before you even set yourself up the foundations of a successful investment portfolio. For every pound you're spending in this bear market on a Gucci t-shirt or a Lamborghini or whatever else it is you're buying beyond your means, that is a pound that could be going into crypto with the potential to 20x, 30x, 50x, depending on the projects you're invested in. So if you're flexing too early, it's going to hold you back. Rule number 19, you're trying to know everything, and this is keeping you poor in crypto. You cannot pick every single successful project in crypto. You're going to miss some. I'm going to miss some. Everybody is going to miss great crypto projects, but that's not the point. You've just got to be able to pick a couple. And if you can pick a couple and do that repeatedly, you're on your path to success. So trying to be knowledgeable in every single field, and like I said earlier, not having an area of competence, that's going to hold you back. Rule number 20 I spot amongst those struggling in crypto is they're too busy working hard and not smart. They're spending hours and hours and hours doing research, reading blockchain white papers, getting into the depths of the nitty-gritty, when they're not working smart. And when you spend time in crypto, you're going to learn there are a few things that you could be doing that's going to give you outsized returns, but you're not spotting those. It's the Pareto efficiency, where you're spending 20% of your time should be giving you 80% of your results. Can you identify the 10-point ball and ignore the 1 and 2-point balls and let them fall to focus on the one that's going to give you the outsized returns in your portfolio? This one's a huge mistake, and that's rule number 21, is you're seeking price validation. The number of times I've spoken about this in my videos where people rely on the market and some green and red candlesticks on a chart to give them validation that their project is doing well. This is a major trapping, guys. If you're investing in a crypto and you're waiting that after you buy this crypto, the candles need to show green to give me validation, you're the exact person that's going to panic when you see red candles. So if you find yourself doing this, this is a behavior pattern that's going to set you up for failure. So in order to identify that, you've got to see when those candles move, do you feel FOMO? Do you feel greed? You should be actively looking to buy in the red, and you should actively looking to scale out in the green. And if you find yourself doing the opposite, you're setting yourself up for pain in crypto. Step number 22, you just accept mediocrity. You just go about your crypto investing treating it like an amateur, and you're wondering why you get amateur results, right? You're not professional. You don't journal your trades. You don't write down things. When you do research, you just kind of, haphazardly watching some YouTube videos. Are you treating this like a job? Are you treating this like a professional where you're writing your research, you're writing reports, you have an investment thesis, you modeled the returns you expect to see, you have a strategy for how to take profit? If you're accepting mediocrity, then what do you expect? When is the last time you've tried your best? Are you even giving this your best? Or are you just hoping that the asset class is going to ride you and get you to success without you trying? Rule number 23, you're jumping between narratives. You're moving too quickly. This was a major mistake I used to make in my business life when I was younger. I would start a startup and then I'd want to go start something else, and I'm falling for this excitement trap, right? It's exciting at the beginning. Things are exciting. They're new. It's fun. And then suddenly 6 months, 1 year into a startup or investing in a crypto, you start to get difficult, right? Some FUD pieces start to come out. You're in a bear market. Things get difficult. And now you're looking to jump ship and go into another narrative. Guys, this is holding you back. If you never had conviction in the first place, why did you invest? Right? You can't keep jumping between the exciting narratives. You're going to keep missing the moves because you're constantly one step behind. Rule number 24, you're following all these guru tips. Yes, you listen to some YouTube video where it says to become a successful crypto investor, you need to wake up in the morning. You need to journal what you're grateful for. You need to go for a 20-minute walk and touch grass. And then you need to do some other mindful practices. No. You just need to get work done. You need to do your research. You need to put in the work. You need to learn technical analysis. You need to learn tokenomics. You need to learn the basics of what a blockchain is, proof of work versus proof of stake. Learn how to analyze a roadmap. It's just work. If you're going to hide behind other procrastination methods, it's going to constantly hold you back. Rule number 25, holding most crypto investors back, is you're letting other people label you. And this is a big trapping, guys. If you find that people in your life are saying, oh, look, this is just the guy that messing around in crypto, he keeps losing money, and you're letting that weigh in on you, you've got to let go of that, guys. You've got to have conviction that what you're doing is right and that you're actually putting in the right work. And one of the reasons you're struggling comes to the point from earlier. You're not treating it like a professional. And so when your mom, your sister, your partner, your other half, whoever else is coming up to you and saying, oh yeah, he dabbles in a bit of crypto, they're right. You're just dabbling and wasting money. You're 90% retraced in a bear market here. You don't treat it like a professional. You treat it like an amateur. How are you going to say otherwise? Whereas the opposite person, somebody who's going to do this the right way, they know what they're doing. They've got conviction. They're controlling their emotions. They've got a game plan. They're treating it like a professional. Rule number 26 to keep yourself poor in crypto is don't double down. If you find something that works, ignore it and go do something else. Don't double down on what works. No, you've got to do what's exciting and what's new. And this is what I find a lot of new crypto investors doing. They find something that works, they untap a bit of gold, but then they go start searching for gold elsewhere. Double down on what works. If you find that you're really good at trading a moving average crossover strategy, keep doing it. If you find that you're good at finding a 5x crypto that tends to 5x in the next bull run, good, keep doing it. If you can keep doing it and doing it repeatedly, you're going to build wealth. Rule number 27 is one which is hugely prevalent, and that is stubbornness. You're just stubborn. Right? You're holding a crypto project, you had huge belief in it, and things have now changed. The project's been hacked, it's had a lot of downtime, it's breaking from a technical perspective, the team have left, and some of the major founding partners have left, but you're still stuck there, you're stubborn, you're hodling, you've got diamond hands, right? And you hide behind this notion of conviction and hodling, when the reality is, you're just stubborn. You don't know when to jump ship, you don't know when to call a spade and say, you know what? I got this wrong. I'm going to put this down as an L. I'm going to take the lessons from it and I'm going to keep things moving. And that ties in with rule number 28, which is rely too much on luck. Yes, you place too much of an emphasis on luck. You find someone successful in crypto and you place it and say, oh, they must have got lucky. You find somebody else and they got lucky. They got in early. Oh, they were in the bull market. That's why. Oh, they just completely lucked out on that one. That was due to the SEC case. You place too much emphasis on luck instead of saying, you know what? Maybe they did their research. Maybe they did some work. Maybe it was in their control. You're not taking accountability. You want to look for something externally to validate your lack of success. Rule number 29, you're repeating the same mistakes over and over. And this is an absolute sin, guys. If I can accept one thing, it's that you make a mistake, you take the L and you take the learnings from it. What I cannot accept in anything, in any of my businesses, in any of my investments, is to make the same mistake twice. If I make the same mistake twice, I punish myself, guys. It's not acceptable. And the people that are staying poor in crypto, or in any field really in life, continue to repeat the same mistakes. We don't have enough time in life to keep repeating the same mistakes. Einstein said the definition of insanity is to try the same thing over and over again, and expect different results. You've got to adapt, you've got to learn, you've got to iterate, and you've got to grow. Rule number 30, holding you back in crypto and keeping you a brokey in crypto, is you're always seeking confirmation bias. This is when you have a certain belief in a crypto, in a project, and all the research you do is to try to validate your own beliefs. You seek out reports and data and metrics and charts which just back up your thesis. You're not looking to challenge your ideas or your belief system, and this is going to hold you back. You should actively be seeking out data that challenges what you believe, so that way you can find weaknesses in your thesis and argument. Rule number 31 is a lack of emotional control, and you can correlate this to the success of many people in the world in various different fields. Those who can control their emotions will fundamentally achieve far better than those who just move at a whim as and when their emotion feels. If you cannot control your emotions in investing and trading, which is arguably one of the hardest places, the markets are irrational, right? You're going to struggle. If you keep falling for FOMO and FUD, you're never going to be able to achieve success in crypto because you're not going to be able to follow a game plan and stick to it. Rule number 32, holding you back in crypto, is a lack of contrarian thinking. You don't look for the other side of the argument. You just accept the status quo and you say, okay, this is what the mass populace believe and therefore it must be true. I'm going to believe it too. You never challenge it. You never do your own research. Sometimes it's really healthy to be skeptical. It's really healthy to have a contrarian, opposing view to the mass public. Rule number 33, holding you back in crypto, is you don't know how to learn. And this sounds bizarre, right? We all went to school and we went through the schooling process at university. Surely we know how to learn. No, the majority of people have no method for how to get better at something, identify a weakness, and put together a plan of how to improve it. I'm bad at TA. I don't know TA. What am I going to do? What's the game plan between now and 3 months? And when I look back, in 3 months' time, I'm far better at TA or tokenomics or fundamental analysis than I was previously. People don't know how to learn. And the best achievers in this world are those that know how to learn quickly. They figured it out. And last but not least, rule number 34 is you spend beyond your means. And that's when you know how to do all the things we've spoken about. You're a great investor. You spot great projects, but the problem is you have no cash to invest because you're too busy flexing. You're too busy spending beyond your means, and there's never enough money for you to invest in these winning projects which you're successfully finding. And that's going to keep holding you back. You've got to figure out your streams of income. You've got to have a little bit of excess income that you can invest in crypto. So there you have it, guys. 34 rules keeping you poor in crypto. And the reason I wanted to list this out was so that we can identify them and make sure we're not falling into these trappings. Now that we've identified them, we can put together a plan to say, I'm not going to be falling into any of these trappings. And if I find myself doing so, I'm going to snap out of it and make sure that I'm not one of the 99% who are going to fall into these harsh traps. If you appreciate this type of content, make sure you smash the likes. Don't forget to subscribe. Check out the link in the description to a free cheat sheet PDF on how to do fundamental analysis. There's also another one in the description on how to do technical analysis with a free cheat sheet of my favorite patterns which you can print and keep on your desk while you're trading. Thanks for watching, guys, and I'll see you in the next one.